Welcome back. In recent years, there's been a growth of exchange-traded funds, or ETFs, and for some, they're used to give a broader exposure to stocks, or they can be used to get a narrower and sectorial, if such a word exists, exposure to stocks. Russel Chesler is from Market Vectors and will explain why some investors may be interested in something called smart beta. Thanks for joining us, Russell.
Thanks for having me on the show, Peter.
So what is smart beta? Sounds great.
So let's start off with the word beta.
Yeah.
Beta is the common term which represents the actual overall performance of the market. So in Australia, the standard measure of beta is the ASX 200.
Correct.
This is what's known as a market capitalization index, where all the stocks in the index are weighted according to their size. But put simply, smart beta is an index which is created differently. It doesn't use market capitalization as a space.
Yeah. What does it use?
Well, it can use various different things, but you get indexes that are looking for high dividends. You get volatility weighted indexes, quality, equal weighted. So there's a variety of different types of indexes.
So smart beta is like a bracket, is like a term, and you've got different ones inside that.
Correct. It's really a broad category, and some people call it strategic beta, alternative beta. So it's developed over time. It probably has come about over the last 10 years or so.
Yeah.
But the key is all these strategies aim to perform better than this market capitalization index like the ASX 200, just like an active manager is trying to outperform the index.
Okay, so equal weight, you mentioned that. Explain that to my viewers.
So we've got an equal weight ETF listed on the ASX under the code MVW. So what we do in there is each of the stocks is equally weighted. So we've got 73 of the large and mid cap stocks in there, and they're each equal weighted at 1.37%.
Now, what's the benefit of that? Because the index will follow according to its relative importance in the index, won't it? So, yeah. So for example, BHP has a certain percentage, so therefore an ETF that has BHP in it will have that kind. Why does equal weight give a different result? Well, that makes logic, but why is the better result?
Well, if you look particularly at the Australian market, it's extremely concentrated. The top 10 shares, which you've got your big four banks in there, you've got BHP, you've got Wesfarmers, Woolworths, you've even got Macquarie Group in there now as a new entrant, you've got Telstra in there.
A lot of financials, isn't it?
A lot of financials. Financials are 40%
the materials
of the ASX 200, but those top 6 have been smart beta.
Yeah.
You take a look at the US experience now, 20% of the ETFs on the exchange are actually smart beta strategies, and they make up $400 billion. And that's grown from $64 billion in 2010 up to that $400 billion now with 350 ETFs.
And it kind of makes sense because in the early stages of a bull market, you can play the index and you can do very well. The rebounds are big. But now you have to start searching for those companies that often have been neglected as people went for the most logical kind of companies.
Yeah, I think maybe it's companies that have been neglected, but it's also, when I was talking about qual, there we're selecting quality companies. So what MSCI there is doing is they're taking their universe of 1,500 companies, which is in their benchmark index, and then they're assigning a quality score to each of those companies based on return on equity. They're looking for a high return on equity. They're looking for strong balance sheets and stable year-on-year earnings growth. And then they're taking those companies, ranking them, and the top 300 get into the index.
Okay, mate. Well, thanks for joining us. So Russel Chesler is from Market Vectors. Thanks for coming on the show, mate.
Thanks very much. Thank you, Peter.
Cheers.